What if I told you that the flippening, the moment XRP overtakes Ethereum and reclaims the number 2 spot in this entire industry, is no longer a meme on crypto Twitter, but a mathematically tracked on-chain event with a completion timeline measured in months, not years? Strong claim, I know. But before you scroll past this video, ask yourself this brutal question. Why is Polymarket, a prediction platform that aggregates the bets of some of the smartest macro traders on earth, now pricing the odds of Ethereum losing its number 2 ranking at 60%, when those same odds were sitting at 17% at the start of the year? They didn't move that number based on hype. They moved it based on flows, on data, on positioning that retail has not yet processed. While the crowd is still arguing about gas fees and roll-ups, something far more structural is being decided behind the curtain. And that something is the quiet, methodical reorganization of which network actually carries the weight of global tokenized finance. Today I'm going to walk you through the on-chain receipts. And the world once again is missing the signal. Welcome back. On this channel, we don't trade hype, we decode structure. Today, we are going under the hood of one of the most consequential narratives in this entire cycle, the mechanical data-driven case for XRP flipping Ethereum, and what the recent explosion in tokenization activity on the XRP ledger actually means for long-term valuation. No moonboy fantasies, no emotional charts, just on-chain numbers, institutional flows, and the positioning that retail has been trained to ignore. Before we go under the surface, this is informational analysis, not financial advice. Let's jump in. Let's start with the hard truth. 99% of investors still think the flippening is impossible because they are looking at the wrong metric. They open a market cap ranking page, they see Ethereum sitting comfortably in second place, they see XRP a distance behind, and they conclude the gap is permanent. But that reading is exactly what the smart money wants you to see. Because market cap is a lagging indicator. It tells you where capital was. It does not tell you where capital is going. And right now, the on-chain flows tell a story that the market cap rankings have not yet caught up to. Here is what almost nobody on this platform is willing to say clearly. Ethereum's dominance in tokenized real-world assets, once treated as untouchable with roughly 65% market share, is being eroded in real time by a network that just 12 months ago, almost nobody included in the conversation. The XRP ledger has gone from approximately $25 million in tokenized assets to nearly $3 billion. That is not a typo. That is not a projection. That is on-chain verifiable public data. And the rate of growth is accelerating, not slowing. Real-world asset transfer volume on the XRP ledger is up nearly 2,000% over the last 30 days. 2,000. Meanwhile, Ethereum's stablecoin transfer volume in the same period is by some measures down dramatically. Tokenized real-world asset transfer volume on Ethereum is down more than 20% over the same window. This is not a minor rotation. This is the early signature of a structural migration. David Schwartz has spoken for years about the design philosophy of the XRP ledger, a chain built specifically for high throughput, low-cost, deterministic settlement with native support for issuing and transferring tokenized assets without the gas friction or congestion that has plagued Ethereum since the last cycle. Brad Garlinghouse has, in interview after interview, framed Ripple's strategy in language that almost exactly mirrors what institutional treasury desks describe as the ideal settlement environment. This is not coincidence. This is convergence. And once you see the convergence, you cannot unsee it. Let's do the math. The kind retail desperately wants to ignore. If you take XRP's current circulating supply, and you ask a simple question. What would the price of one XRP need to be for it to flip Ethereum at today's market cap? The answer is roughly $4.60. That is approximately a 3.2x move from current levels. And if you ask the more ambitious question, what would the price need to be for XRP to reclaim Ethereum's all-time high market cap? You arrive in the range of $9 to $10 per token. That is a 6 to 7x move. These are not moonboy targets. These are the mechanical outputs of dividing a market cap by a circulating supply. The math is boring. It's also undeniable. Now layer on the historical context that retail keeps forgetting. In the 2017 to 2018 cycle, XRP delivered nearly a 350x return. 350 times? Bitcoin in the same window returned roughly 14x. Ethereum returned roughly 100x, which means that in a previous cycle, XRP outperformed Bitcoin by more than 24x and outperformed Ethereum by more than 3x. And it did all of that before Ripple completed a single one of its major institutional acquisitions, before the regulatory clarity question was even framed correctly, and during a period when the network had a fraction of its current utility footprint. Ask yourself this brutal question. If XRP could deliver that kind of move in an environment with no institutional infrastructure, no clarity, and no tokenization pipeline, what is the realistic ceiling in an environment where all three of those conditions are now in place simultaneously? Here's the math that the retail crowd ignores. Ripple has, since 2017, deployed over $3 billion in strategic acquisitions, specifically to build institutional-grade infrastructure around XRP. Metaco, acquired in 2023 for roughly $250 million, brought bank-grade custody, now used by major institutions. Standard Custody, acquired in 2024, delivered a New York-regulated trust services foundation. Hidden Road, acquired in 2025 for $1.25 billion, gave Ripple a prime brokerage clearing trillions annually. Rail in 2025, $200 million, brought stablecoin-powered payments into the stack. G-Treasury in 2025, $1 billion, delivered corporate treasury management for Fortune 500 companies. Palisade in 2025, advanced wallet and custody technology. This is not a startup hoping for adoption. This is a fully assembled institutional stack waiting for the regulatory switch to flip. This isn't a prediction. It is a requirement of the design. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the on-chain ledger, with public M&A filings, and with the math of network effects. While retail is panic selling and complaining about XRP's price action over the last few months, the institutional signal has never been louder. Look at what is actually happening, not what is being broadcast on social media. United States spot XRP ETFs have already accumulated approximately 1.23% of the total XRP market cap, worth more than $1.08 billion, with more than $75 million flowing into the funds in a single recent month. Tuttle Capital has filed for an XRP Income Blast ETF. Multiple additional ETF products are queued in the pipeline. This is not retail chasing momentum. This is regulated capital deployed through registered investment vehicles, accumulating systematically. Ask yourself this brutal question. Does a firm with the legal exposure of Ripple, after years of litigation against the SEC, deploy over $3 billion in traditional finance acquisitions without absolute certainty about the regulatory and structural endgame? Absolutely not. They don't gamble. They position. And the people who really matter, the silent actors, are positioning right alongside them. Look at the broader chessboard. Larry Fink, the CEO of BlackRock, has gone from publicly dismissing crypto to championing tokenization as the future of every financial asset on Earth. Franklin Templeton has launched on-chain money market funds. Fidelity has expanded its digital asset custody operations. Luke Judges, in middle management at Ripple, has publicly shared on-chain data showing that net flows into tokenized assets on the XRP ledger recently reached $1.1 billion in a measurement window where Ethereum's net flows in the same category came in at $879 million. That is XRP flipping Ethereum on-chain in a tokenized asset flow metric right now, not in some future cycle, but in the present quarter. And almost nobody in mainstream crypto media is reporting on it. The retail crowd is staring at price. The institutions are staring at flows. One of them is going to be very, very right. The other is going to be writing comments on YouTube about how they were lied to. So when does the on-chain reality collide with the market cap rankings? Pay attention here, because the catalysts are no longer theoretical. They are scheduled. The Digital Asset Clarity Act and the broader market structure legislation moving through the United States Congress represent the final regulatory green light for institutional tokenization at scale. Once a clear classification framework is in place, the risk premium that has held back trillions of dollars in compliance-bound capital evaporates overnight. That is not a slow drip. That is a gap event, the kind of event where rankings reorganize within weeks, not years. In Asia, Japan's Financial Services Agency has already moved decisively to recognize XRP as a regulated digital asset, opening the door for one of the most disciplined institutional markets on earth. The Bank of Japan continues to publish CBDC research that explicitly discusses interoperability layers. The European Union's MiCA regulation is now fully operational, providing the legal certainty European banks have been demanding for years. Each one of these developments removes another barrier between institutional capital and the XRP ledger's tokenization stack. And, critically, the institutional DeFi portal on the XRP ledger is not even fully live yet. The numbers we are looking at, the $3 billion in tokenized assets, the 2,000% transfer volume growth, the nearly $500 million in stablecoin market cap, all of that is happening before mass institutional adoption arrives. That is the most important sentence in this entire video. We are watching pre-adoption traction. Imagine the post-adoption picture. Then there is the macro layer. Jerome Powell and the Federal Reserve are pivoting toward an environment of expanded liquidity. Global debt levels are forcing every major central bank to consider new forms of settlement that bypass the bottlenecks of correspondent banking. The IMF has openly discussed the need for a more efficient cross-border architecture in multiple working papers. When the wait-and-see money becomes the all-in money, and that transition is no longer a matter of years, but of quarters, the flippening will not happen on a smooth, gradual line. It will gap. The fuse is already lit. Now let's talk about the side of the equation most people refuse to confront: supply drain. While the demand side is being assembled in boardrooms in New York, London, Tokyo, and Singapore, the supply side is quietly being removed from the open market. Exchange reserves of XRP have been trending lower. Tokens are leaving exchanges and entering custody, including, increasingly, custody held by registered ETF issuers. CryptoQuant data, Glassnode analytics, on-chain forensic researchers, every credible source confirms the same trend. Once a token enters a multi-signature institutional vault or an ETF custodian's reserves, it does not come back to market for a 10% profit. It is gone, it is parked, it is reserved, and on top of that, there is the security layer. We just watched a major exchange, Kraken, face an extortion attempt from a criminal group threatening to release internal systems and client data unless they were paid. Even when exchanges are not being hacked, They are being extorted. This is exactly why institutional and informed retail capital is migrating off exchanges and into qualified custody, accelerating the supply drain. Every wallet that moves from a hot exchange address to a cold institutional vault is a tightening of the tradable float. And a tightening float, meeting expanding demand, is the textbook definition of a supply shock. We are moving from an era of abundance to an era of scarcity, and the rankings have not priced this in yet. Think about what that means in practical terms. When the regulatory switch is flipped, when the institutional DeFi portal goes live, when the next ETF wave hits, the available float on exchanges will be a fraction of what it appears to be on paper today. Order books will be thin, buy walls will be hollow, and the price discovery process will not be gradual. It will be violent. The flippening will not be a slow climb on a chart. It will be a series of step changes that retail will look at later and say, I should have positioned before that. There is a phrase you will start hearing more often in the next 12 months. The great priced out. It refers to the moment when retail realizes they can no longer afford whole tokens, only fractions, only drops. 1 XRP equals 1 million drops, and very soon, drops will be the only unit late retail can afford to accumulate. That is not a doomsday prediction. It is the natural mathematical consequence of a fixed cap asset meeting institutional flows at the same moment that supply is being absorbed into long-term custody. The window is closing, not in years, in quarters. I know exactly what you're feeling right now. You're watching XRP's price action down significantly from its recent highs. You're reading headlines designed to make you doubt yourself. You're seeing influencers pivot to whatever shiny narrative is trending this week. And the temptation to give up, to sell, to walk away, to accept that XRP missed its moment has never been louder. I understand that. But my job is to help you distinguish between noise and signal. The price action is noise. The FUD is noise. The boredom is noise. The signal is what is being built underneath all of it. 3 billion in tokenized assets, 2,000% transfer volume growth, over 3 billion in institutional acquisitions, over $1 billion in ETF accumulation. None of those things stopped because the price went sideways. They accelerated. Being early feels exactly like being wrong, right up until the moment reality catches up. That is the cruelest psychological trap in this entire industry, and the institutions know it. They are counting on it. They need a steady stream of exit liquidity from the confused to fund the entry of the informed. The question is not whether XRP will flip Ethereum. The on-chain data already shows it happening in specific metrics in real time. The question is who will still be holding when the market cap rankings finally catch up to the structural reality. If you've made it this far in the video, you are not the confused. You are the informed. Hold that line. Let me leave you with this. Market cap rankings are a distraction. On-chain flows are the reality. One is a snapshot of the past. The other is a blueprint of the next cycle. The question is, are you watching the leaderboard or are you watching the ledger? History does not reward comfort. It rewards those who pay attention when the room is quiet. And right now, the room is very, very quiet. If you made it to the end of this analysis, drop the word flippening in the comments. I want to see who actually understood what was decoded today. If you value this kind of deep structural breakdown, subscribe and turn on notifications because the catalysts are accelerating. The math doesn't lie, and the system is almost complete. Stay patient, stay rational, and as we always do, we don't wait for the future. We plan for it. This content is for informational and educational purposes only and is not financial advice. Always do your own research before making any investment decision.